Hey everyone, hope you're having a good day. My name's Andy, channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'm going to give you my financial opinion as we go through it. It's generally related to three topics: financial topics, commodities, or wealth building. Let's dive in. Let's see what people are talking about today. If you want to follow me at finding_finance, and if you want to join our community, finding-value.com, where I go over individual sectors and companies. You can see what I'm doing, what I'm buying. If you need any help, you can even go to our question and answer sessions and ask about specific companies, and I will tell you what I think about them in a truthful manner. I will not say that if I think a company is not worthy, I will let you know that and give you the reasons why. All right, U.S. production versus rig count. You can see the green line is production, the blue line is the rig count. And what I see in the rig count is a one hump, two hump, three hump consolidation that we have broken out of that falling wedge. And I think that we're pretty much bottoming in terms of rig count because rig count can only get so low. And when you get low enough, it can't maintain production. We are eating through inventories worldwide in terms of oil. And I think the rig count is probably going to bottom here at some point and start to go higher. And you're going to see energy service companies start to move up as well. Rig count is also dependent on not just crude oil, but also on natural gas as well. So it's a combination of those two things. And we're going to talk about natural gas as well. And I do think nat gas is probably pretty close to bottoming. So two big revisions here by Goldman Sachs and Moody's. Goldman Sachs forecasts a model now expects U.S. home prices to rise 5% in 2024. Moody's, on the other hand, now expects U.S. home prices to fall only minus 0.4% in 2024, which was previously minus 4.4%. Who is right? Is it dependent on interest rates going down? I think we're in the thick of a big housing boom. It's an expansionary phase. We're kind of in the middle of it. And I think house prices will go up, especially if we get interest rates to pull back a little bit. Will we get that pullback? That I do not know. Now, here's an interesting one on natural gas. So, new bottom left theme on the board today. Some themes change, some stay the same. What would you add or subtract? And this is the investing themes in North American natural gas. I'm going to hit these corners up. I'm not so much in the middle here. So, this is where I kind of lie in it. I'm going to hit the blue ones first. Long-term LNG export restrictions would be both negative for nat gas producers and negative for natural gas prices. In the upper left here, resource depletion and productivity degradation is positive for natural gas, not really positive for all of the natural gas producers. Then we've got M&A that tapers activity in the combined entities, the independents, so people merge together and they don't just produce flat out all independently. We've got 2025 to 2028 LNG export boom. We've got AI data centers drive energy growth renaissance, and that's what I also think is coming. M&A that grows activity in the combined entity majors, nearer term growth, less right, you're going to cut right. Another thing that also is here is they've got here being negative nuclear SMR power competition. But I would say that this is in the wrong location. I actually think it's going to be positive for gas prices because I think if we do have a shortage of uranium, nuclear, yes, if you can generate power, yes. But here's some other things that I think are positive for natural gas that are not on this grid. And you can determine if they should be on the grid or not. Copper deficits running out into the late 2020s will restrict how much electricity can be pushed onto the grid and will limit grid uh, production. Aluminum will as well. So aluminum shortages and copper shortages could impact the mass upgrades of the electrical grid that are needed, and that will drive potentially other scenarios there. We also have a scenario where uranium supply gets so dire that nuclear expansion, nuclear and SMR power competition cannot expand as rapidly as thought, which then means that the power needs to be generated some other way. So um, right now we're seeing power burn go up quite a bit for natural gas, and wind generation and renewables are not, they're actually increasing the demand for natural gas. If we can't grow our nuclear in the world as fast as we want, and this is for the world basis, not just North America, I think natural gas power burn will continue to increase if we have any sort of problem with uranium supply, because uranium is ultimately generating electricity. And if you cannot generate electricity from nuclear, and you cannot generate it reliably from wind or solar, nat gas is basically making up the difference for all of that. Now, I combine these as my thesis for natural gas. My thesis is we're going to get an LNG export boom. We're going to have potentially problems in uranium because uranium is so long cycle. I don't know how much we can grow production quickly. So I think there's going to be a gap between when nuclear can come on and today. I think that AI data centers are going to drive a massive amount of electricity growth. And I think that will be coming to some extent. I don't know how transformative it will be. And I also think that electrical vehicles are going to try to grow, but I think they're going to be limited by the inputs for electrical vehicle cars, whether it be rare earth metals, copper, aluminum, et cetera, whatever it is. And I think we're going to see a big push higher for uh, those metals. But I think those metals are in short supply. So I think the backup here, if we cannot put everything onto the grid, and I think there's going to be difficulties with the grid handling all of this electricity, I think oil demand is going to rocket higher. And what's going to happen is aluminum and copper prices are going to go up. And what does that mean? That's ultimately more demand for oil and diesel. So a lot of these situations is I think we are going to get increased demand for oil and even natural gas if we cannot perform to where we want to be in nuclear, if that doesn't occur that way. And if we don't have the materials to build out electric vehicles or the power transmission grid, I think demand for oil is going to go higher, and gasoline and diesel. And remember, copper, aluminum, and all these other metals are just a derivative of oil. Down the issue at Ortelic, well, however you say that, as a result of the lack of availability of sulfuric acid, suggests the same dynamic at play for a number of KEP assets that had a planned ramp. KEP has planned a ramp, a number of their assets which won't happen without acid. It's bullish for uranium. Now, this is their big ramp that they pulled out of their butt. I don't think it's going to occur. And what I get afraid of is there enough uranium in the world to, basically fuel all these nuclear plants and restarts that we have in the world? And my answer is I don't know. I mean, I'm listening to some of these guys talk, and they don't think it is. They don't think that there's enough in the system necessarily to maybe cover it. But we'll see. We'll see. And I think natural gas would be the thing that maybe covers it. Did I skip one up here? No. Oh yeah, I did right here. Here's another one here. Oh no, that's down a little ways. Okay, we're good. We've got uranium here going on up. the breakout after a 580% baby bull move. We've got, yeah, so that's a great chart there. It's breaking out. It's ready to go with a rounded bottom on URA. We've got another one. He's talking about, could uranium prices hit $1,000 a pound? I'm hearing more and more talk about $1,000 a pound. I know Scott and I brought up prices between $600 a pound and even all the way up to $1,600 a pound, depending on how you calculate it against certain assets. But could we spike to 1,000? It's possible. He even mentioned it that it's possible in this interview there. Coming down, we've got Trafigura says oil tanker struck by missile in the Red Sea. Oh man, I think tanker rates are probably going to go higher. I'm a big chart guy too, and I look at the charts, and I think there's probably some pretty good setups around investments in the oil tanker space. Yeah, there's definitely some investments around this here. The dangers of day trading. Phenomenal quote by Howard Marks. I think I've read this a long time ago, but let's go over it one more time. Day traders consider themselves successful if they bought a stock at 10 and sold it at 11. They bought it back the next week at 24 and sold it for 25. And they bought it a week later at 39 and sold it for 40. If you can't see the flaw in this, that the trader made $3 in a stock that appreciated by 30 bucks, you probably shouldn't read the rest of this book. And that's what traders see versus missing the big move. I invest for the big move, for the 10 to the 40 move. And it takes and requires you to be more patient and to have a little bit different mindset than a trader. Scrolling down, housing's biggest supply constraint is developable land. While America has a lot of land, local governments have been making it more difficult to obtain development approvals and also make land expensive to develop. The 9 largest builders in the country are barely growing. So these are the 9 largest builders. And we're in this middle of an expansion phase, and these guys can't get development land to basically development on. So this could be an interesting, and it could be a longer bull market. And this here is the historical net lot acquisition. You can see it was negative in 2022, and it's still not that high compared to history. We had a little bit of a boom in 2020, 2021. 9 in 10 homeowners have a mortgage rate below 6% per MW. Okay, that's interesting. Ford loses $36,000 on every electric F-150 Lightning sold. They're firing 70% of EV workers and ramping up gas vehicle production. Greta may be pissed, but Americans are speaking loud and clear with their wallets. We don't want to be forced into electric vehicles. Another thing where gas diesel demand continues to be the option of choice. I think people are looking at the convenience of just sitting there, filling it up, and going, and maybe even the versatility of ICE vehicles in cold weather. Interesting. GDP didn't exceed expectations given the deficit spending and disinflation impulse. The media economists should really try harder. Nominal GDP fell as expected. So the data here is the debt is up 47%. GDP is up 40% since 2020. Inflation is reported since 20%, which then shows the economy has, quote, grown. And this is what I'm talking about. The contraction in the economy is being hidden by the inflation that they report and by the debt that they're spending and fiscal spending. It's covering it up. And asset prices may not go down in a nominal sense. So, I mean, just keep that in mind. But a lot of assets are going to move up based off of the inflation in the system. An interesting thing I've noticed in wealthy families, the spouse that created the wealth is extremely humble and reserved. The spouse that did not create the wealth is extremely loud and obnoxious. That's interesting. Very interesting there. Here's Gergen. He says these are butamin realization estimates based on, I think that's Western Canadian Select and Condi strips. Canadian heavy producers should do much better. This is butamin realization in USD per barrel. You can see we ran up and then we've pulled on back. And it looks like to me that we were bottoming here at some point in the 52 range in February of. Oh, this is looking forward. Sorry about that. March 24, looking forward. That's what the curve looks like out ahead of us. Sorry about that. I misread that. Coming down, we've got pay attention to copper before it derails the energy transition. Robert Friedland, he is a CEO of Ivanhoe. He pays probably the closest attention to the copper market. I listened to a couple of interviews he had. I like listening to the insiders. And he basically thinks that we're going to run a deficit here in 2024. Copper is going to go up dramatically, and things are going to get very interesting. It could potentially derail the energy transition, which then goes into my thesis that natural gas, electric vehicles probably won't be as strong and powerful. Even from the demand side, the customers don't want these vehicles as much as what I think people think. And then from the supply side, it could get even more expensive as more copper uh, goes into these vehicles. And if the price goes up, those electric vehicles become less competitive with ICE vehicles. Is the physical gold revaluation nearly upon us? And I looked at this chart, guys. This is the federal government current expenditures, interest payments alone. My God. And I know I had another chart up here which goes vertical to 2030. This is this fiscal spending, the deficit spending, the debt. And I think it's going to get a lot worse. Climate activists concerned LNG might decrease use of coal. Germany shut down their nuclear reactors and are burning more coal now, so coal must be green, right? So that's a response to this. So I'm going to talk about this. Biden is set to halt review on natural gas export approvals on Friday. Move comes amid growing concerns for climate activists. U.S. is the world's largest exporter of liquefied natural gas. I think what they're trying to do is they don't want natural gas prices to go up. They want to hold them lower. And then at the same time, this guy says climate activists concerned about LNG might decrease use of coal because they're burning a far more amount of coal over in Germany after they shut down their nuclear reactors. They're going to maybe shut down liquefied natural gas to some extent, limit the total capacity. And what are they going to do? Burn coal? I mean, guys, this is stupid. Completely and utterly stupid. Amy says since 2001, median rents have risen by 21%, while the median annual income for renters has risen just 2%. And what this says here is housing is now unaffordable for a record half of all U.S. renters, study finds. I hate to say it, guys, but if you're in the largest deficit of homes, this is exactly what you would see. All of the data that I see is supportive of my views on the real estate market and where we're at in the cycle. Everyone else just spews all this information. She's real pissed about it. Probably doesn't own a home or something, is my guess, and wants to own one. But a lot of the data that I see, it makes perfect sense. Homes are unaffordable because you're in the largest shortage that there's ever been. I mean, it's that simple. SPX, my bearish core scenario for this year. Complacency and euphoria are dominant, but a contrarian strategy suggests this possible scenario. My opinion, as always. So let's look at this data here. What he's got is a cycle. Basically, things move. He's got this cycle here where they cycle up, back down, cycle up, back down, cycle up, back down. And that cycle, you can match that kind of rhythm, is what he's matching. So it's a wave B 2-year cycle top projection. And what he's got is the cycle top is potentially where we're at today and a move lower potentially. That is exactly what I think could potentially occur is we get a cycle lower in the S&P 500 and the NASDAQ, not only because of this cycle here, but it's because of where I think we're at in the overall expansionary phase of real estate, the increasing yields, and where I think commodities will go, and the shortages and deficits in the commodities markets. It's going to force the overall markets like the S&P 500, to revalue itself, given that people are going to look at the market conditions that are changing unfavorably for S&P 500 companies. That is my reasoning behind what I think is coming. We remain opportunistically bullish for U.S. expected LNG capacity, and this starts from 2016 to 2030, and that capacity just ramps. I know I've showed you this before, but guys, this is going to be ridiculous. If they actually put the majority of these things in place, oh my goodness, we are going to be looking at a very different market for natural gas. And that impact really hits again in 2024. There was a period in 2022 to 2023 that nothing was really built. Now we've got a large move higher again for LNG capacity, which will impact, I think, natural gas. What's the most crowded trade right now? What's the most crowded trade? I would say the most crowded trade is in the tech sector, crypto sector, and probably the S&P 500. Everything else, like commodities and whatever, no, it's not crowded at all. Like no one's over here yet. Nobody even gives a crap about it. Yes, we follow Twitter, you follow me, and I talk about commodities on a day-to-day basis, but the general sector, they have no idea what's coming. No idea. Grady says gold is insurance, silver is insurance plus speculation, platinum is speculation on steroids. Yeah, my boy Claddy, baby. If silver's at least a 17x from here, which I really do think, imagine where platinum would be if this ratio goes back to all-time highs, which is likely. It says when this chart moves up, platinum outperforms silver. And we've got massive yearly bullish candlesticks as bottoms. This means that platinum would outperform silver by a 5x if we went to the all-time highs. If he thinks that there's a 17x in silver, we could potentially 4x that 17x. And I don't know if that's going to be the necessary case. Maybe it is. Maybe something occurs in palladium and platinum where we get this big blow-off move to the upside, but I think something's coming. I am positioned for it. Platinum is cheap not only against silver, but it's cheap against palladium and also gold and also rhodium. It is cheap against all the other metals. And what risk are you taking if you own the physical metal? Not much risk because there's no third-party risk. It is an absolute beautiful investment. Go Grady on this. Another one that I keep wanting to put in front of people's faces. This is the gold 53-year chart. In a resumed bull market, there's always a next resistance until there is not. The red parabola line fits perfectly, and the time frame makes complete sense for a move like this, where we get a big, huge blow-off move in a third and final bull phase for gold, which is probably the end of the currency. Now, here's the thing, guys. You need to know history to make money to some degree. When gold went up in a hyperinflationary environment, platinum went up 5.5 times the price of gold in the hyperinflation in Germany. The ratio was 5.5 to 1 ounce of gold. So 1 ounce of platinum was 5.5 ounces of gold. So if gold goes some vertical move and you get this big move in silver, platinum's going to outperform potentially all of them. Now, does that mean that I put all my money in physical platinum? I mean, one could think that way, but I have a diversified basket of platinum, gold, which gold is underweight, and silver. So I'm overweight silver and overweight platinum. But man, these things are such great opportunities. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. And I go over all sorts of stuff like this in terms of how do we take this information and put it into investable format. You know, what vehicles should we invest in? Should I allocate to physical metals? How much have I allocated to physical metals? And again, I can only share what I do, not tell you what you need to do. You have to make that decision yourself. But In order to make informed decisions, you need to know kind of where the risk reward is at, what does a good entry point look like, and it makes a very big difference. It does not make a few percent difference. It makes a world of difference to get very good entry points at very good opportune times, and then ride the bull market through it. So that's what I've got for today, guys. We'll catch you later. This is Finding Value.